On the afternoon of February 5th, 2018, a single financial product worth nearly $2 billion effectively ceased to exist. Not over weeks, not over days, in under an hour. It was called 14, and for years it had been one of the easiest ways in the world to make money, right up until it wasn't. The people who owned it were not reckless gamblers. Many were ordinary investors who had found a trade that seemed to print cash month after month. What almost none of them understood was that the product they held contained a hidden engine. And under the right conditions, that engine would run in reverse and tear itself apart. This is the story of Volmageddon, the day the market's calmest trade became its most violent. Here is the idea in one sentence. For most of the years before this day, betting that the stock market would stay calm was a remarkably reliable way to earn money. That is the whole trade. You were not betting that stocks would go up. You were betting that fear would stay low. And it worked, because fear, measured by the market's volatility, spends most of its time drifting slowly downward after every scare. The reason this matters is that the trade quietly grew enormous. Billions of dollars piled into a handful of products that all did the same thing, all leaning the same direction. When a trade gets that crowded, it stops being a clever idea and becomes a structural risk. Everyone is standing on the same side of the boat. The interesting question is not why it paid so well for so long. It is what, exactly, was waiting on the other side. So what was this product? Its name was WIT14, and that is VIX spelled backwards, which tells you almost everything. The VIX is Wall Street's famous fear gauge. It rises when investors rush to buy protection against a falling market, and it sinks when they relax. WIT14 was an exchange-traded note designed to do the opposite of the VIX. Roughly speaking, when volatility fell, WIT14 rose. When volatility jumped, WIT14 fell. To deliver that, the product effectively held a short position in VIX futures, contracts that profit when expected volatility declines. Through the long, sleepy bull market that ran into early 2018, volatility kept grinding lower, and WIT14 kept climbing. It had become a crowd favorite. But a product that is short volatility carries a brutal asymmetry baked into its very design. When you are short volatility, your gains are slow and capped, and your losses are fast, and, in theory, almost unlimited. The calm years hid that asymmetry. They did not remove it. So the real question becomes mechanical. What was this product forced to do on a day when volatility did not fall but exploded? Here is the engine, and it is the heart of the whole story. A product like WIT14 has to keep its exposure balanced every single day. It targets a roughly fixed amount of short volatility. Now picture what happens when volatility starts to rise. As VIX futures climb, the product's short position is losing money, and at the same time, that position grows larger relative to the shrinking pile of money backing it. To get back to its target balance by the end of the day, the product is forced to do one specific thing. It has to buy VIX futures. Read that again, because it is the trap. To protect itself as volatility rises, a short volatility product must buy more volatility, the very thing that is hurting it. Now multiply that across all the similar products and the traders who anticipate them. A jump in volatility forces a wave of buying in VIX futures. That buying pushes VIX futures even higher. Higher futures force even more buying. The hedging that was supposed to keep the product safe, instead, pours fuel on the fire. This is reflexivity. The act of trying to survive the move makes the move worse, which forces more of the same trade, which makes it worse again. On a calm day, the loop barely turns. On the wrong day, it becomes a spiral. There is one more detail that turned a bad day into a catastrophe, and it is about timing. These products do most of their rebalancing near the close, in the final stretch of the trading day. So all that forced buying of volatility did not trickle in evenly. It bunched up into a narrow window late in the afternoon, exactly when the market was already thin and nervous. The futures the products needed to buy were the same futures everyone else now knew they had to buy. Picture a room where everyone is rushing for the same small door at the same moment. Prices for VIX futures gapped violently higher in those final minutes. And there was a second trapdoor. Many of these notes carried a clause in their fine print. If the product lost more than a set amount of its value in a single day, often around 80%, the bank that issued it could trigger an acceleration, a forced wind-down. So as the loss deepened past that line, the trade stopped being something you could ride out. The structure itself was now counting down to its own termination. Two forces, the feedback loop and the wind-down trigger, were now pulling in the same fatal direction. So what did the numbers actually do? On February 5th, 2018, the VIX more than doubled. It closed at about 37, up from about 17 the trading day before, a jump of roughly 116%. That was, and remains, the largest single-day percentage increase in the fear gauge on record. The broad market fell hard alongside it. The Dow Jones Industrial Average dropped about 1,175 points, at the time, its worst single-day point decline in history. And the S&P 500 fell about 4%, its biggest one-day move in years. But the real carnage was inside the volatility products themselves. XIV lost about 96% of its value, much of it in a span of less than an hour late in the day. A product whose net asset value had been near $1.9 billion just days earlier was effectively wiped out. The next day, Credit Suisse, the bank behind XIV, announced it would accelerate and terminate the note. The trade that had paid so patiently for years gave back almost everything in a single afternoon. The people hurt were not abstract institutions. They were holders who had watched a number go up so reliably that the risk had become invisible to them. So what is the lesson here? Beyond a dramatic story, it is that the danger was never really about a single scary afternoon. It was structural, built into the design of the products and the crowdedness of the trade. The short volatility bet had a shape, small, steady gains on the way up, and a rare but enormous loss waiting at the bottom. For years, holders saw only the steady part and mistook it for the whole picture. The feedback loop did not appear out of nowhere on that February day. It was always there, dormant, waiting for a large enough shock to switch it on. And here is the part worth sitting with. The short volatility trade did not die that day. Similar products and similar strategies still exist, still collecting that same patient premium, still carrying that same hidden asymmetry. The shape never went away. So the useful habit is not to predict the next blow-up. It is to ask, whenever a trade seems to pay almost too reliably, what is being sold and what happens to it when everyone has to head for the same door at once? If breakdowns of the market's hidden machinery are useful to you, there are more of them here. This channel explains how markets work. It is educational, and it is not financial advice.